is Stephen Wieting. He's a U.S. economist at Citigroup. And Stephen, what do you think about, first off, what you heard from the Fed chairman? You weren't expecting any QE3, any new policy moves.
Right. If you had low expectations, like most economists did, in terms of announcing any new policy initiatives, well, he certainly met those expectations. Last year, the Fed could talk about innovations, things that they could consider at the zero bound on interest rates. At the time, the investment community, many of them did not think that the Fed could do anything at the zero bound, despite admonitions that they could. So it was much more difficult to surprise by talking about those things. In reality, he dwelled on many of the positives, comparing us now to the depths of the crisis. It's obviously a better position for the economy. He did draw some attention to what will now be a two-day FOMC meeting on September 20th and 21st, but that's because of the complexity of the situation. And, he also mentioned that there is an urgent need to boost the economy in the near term, but he's explained that in terms of the policy steps that they have just taken, not in terms of new initiatives.
And you, by the way, don't expect a recession, at least not imminently, but you do see the U.S. economy as in a pretty dire spot.
Our problem seems to be an inability to grow adequately to reduce labor market slack. I think some people are probably looking for a much higher probability of recession, and I think it's a little more difficult than that. I mean, we have 7 million fewer people working in cyclical industries. We're selling fewer than one new home per 1,000 Americans annually. Things that go down in a recession are fairly well washed out. But the absence of growth is important too. You won't improve the federal balance sheet. You won't improve consumer balance sheets unless you get vigorous enough growth to reduce unemployment. And that's a significant problem.
What do you think? You mentioned housing, and yesterday the New York Times had this front page story on the administration maybe considering allowing Fannie and Freddie to help us, or everybody pretty much, refi their mortgages at 4% flat. Do you think that would be a decent solution? They were saying maybe it would free up a lot more money for households to spend in the economy.
Well, every solution has a cost. I mean, unless you get pervasive refinancing, it's very difficult to assume that you're going to get huge numbers for consumers. But if a significant share of consumers refinance, the good news about that is it lasts for years to come, and that can be a good thing. But, federal policy played a role in boosting housing to an unsustainable level. It's an open question now, a policy preference on whether you want to sort of double down and really make more of that or not. But we need aggregate economic policies that are going to make sense for the long run.
One final question. Paul Krugman wrote today in an op-ed in the New York Times that he thinks Ben Bernanke should be following tools that Ben Bernanke prescribed for Japan in 2000. One of them is setting inflation targets at maybe 4% to force savers out there. Another one is to drastically devalue the dollar to help us boost exports. Do you think those are good policy solutions?
Well, in particular, a higher inflation rate I do not think is a good policy for the United States, because there's been almost zero linkage between wages and prices. And it's not the economy that it was in the 1970s or 1960s, where if you had a higher inflation rate, you were talking about gains in real wages. We might not see that this time around. I'd also say that a great deal of our future federal liabilities are inflation indexed, or effectively inflation indexed. So that's a hard one to think. If we could somehow achieve higher real wages and stronger aggregate real economic growth, that's the policy that you would want.
All right, hey, Stephen, thanks so much for joining us. Stephen Wieting, U.S. economist from Citi, joining us here on the floor of the New York Stock Exchange, where we have market rally underway.